And I want you to see that we've taken out the short-term high and the short-term low. So we have a high here that took price higher, broke that, traded lower, took that low out there. Okay, whenever you hear me refer to a dealing range, what I'm looking at is a range where price has taken out buy side, then reversed and taken out sell side by the movement here. Okay, that makes this range from here to here a dealing range. Okay, so an ICT dealing range, whenever you hear me refer to that, why am I working with a specific range? Why am I looking at one high and this high? Why am I pulling my fib from this low to that high? All those questions are answered right here. So we have a dealing range from here to here. So in this range, the question is how's it useful? Well, prior to this run up here, what has the dollar been doing? It's been bullish. I have been bullish on dollar. I've been looking for higher prices in dollar, and for the most part, it's been delivering okay. We've entered a little bit of a sloppy range in here this past week, and that's fine. So when this low is taken out here and sell side's taken, I'm not looking at that as a market structure shift where it goes up to here, runs to a gap, and then go lower, because I'm trading against the primary uptrend. If I do that, that's the same as trying to pick a top, and I don't try to do that. I've lost a lot of money as a young man trying to do that. So I submit myself to the market being likely to follow its higher time frame bias, trend, momentum, direction. Okay, so I look at that run below that low here as accumulation of sell side liquidity for the purpose of buying it by smart money. So stops here being triggered, that's a flood of sell orders coming into the marketplace. And why is that useful and how is it useful? Smart money, if they're bullish and they're going to align themselves with the higher time frame trend as well, they're going to buy those sell stops. So I'm going to look at that run below here as a means of buying dollar. I'm not specifically buying dollar. I don't ever trade the dollar, but I use it as a barometer. What does that mean? I'm using it in my analysis to determine if this is going to go higher, then foreign currency should go lower. If this is going to go lower, foreign currency should go higher, vice versa. It's like a teeter-totter. So how this is useful is the dealing range that's been created by running out the short-term low here. I expect sell side to be accumulated so that way the market starts to trade higher. What would it trade for? Well, the dealing range has been defined by this low being taken out and this high here taken out. So we have buy side here, sell side has been taken, and if it turns higher, once it starts to pull away from this low, sell side resides here. And if I'm bullish, because I'm sticking with the higher time frame trend, I'm not trying to pick tops, the draw on liquidity is going to be that high because that's where buy side is. So I'm not going to look at this run up into this range here for a fair value gap to sell off on dollar. That's not what I'm doing. I don't look for that. My students know that. So I'm going to be anticipating this range to be taken out. So the smart money buys the sell stops and then sells to the buy stops. There are traders that want to be short dollar. If they're shorting dollar, they'll put their protective stop loss right above the short-term high here. And that provides what? Buy side liquidity. How's that useful? The smart money that buys the sell stops here will offset to those buy stops above the short-term high. So they're buying low, selling high. Who are they selling to at a higher price? The buy stops resting above here. That's narrative. Okay. So looking at the dollar, we didn't do very much last week. We kind of stayed inside the range here. So here's Friday, Thursday, Wednesday, Tuesday, Monday's range to Friday, just a consolidation week. Okay. Euro dollar. High probability conditions with my concepts and my analysis method is the algorithm presenting something in price that is so one-sided. It's so obvious that it wants to go higher or go lower that it's very difficult for you to make a justification for the opposing side. In other words, if you're bullish and you think the price is likely to go higher, does this condition or market present next to no opportunity to present a shorting opportunity? So it's going to be obvious. This is high probability. If there is a way for you to determine a likelihood of an opposing setup, that is not my definition of high probability. So what are we waiting for as traders? What are we being patient for? Because I preach that all the time. You're waiting for that one-sidedness to the marketplace. And it might not trade like that for a day or two, or maybe even a week. And you have to prepare yourself to have that patience to wait for the setup to present itself to you with high probability conditions. The market comes back up into this fair value gap. It ran up into that. Why didn't it drop? I don't know. Why didn't it go higher? I don't know. Just because the markets are printing candles, I'm not trying to predict every single fluctuation in every single market. I want to go where the iron is hot, and I want to strike it when it's there. Because I'm going to shape a winner out of a market that presents the opportunity that's high probability. So what I'm showing you here, notice I'm not taking you into where the market's going to go to next, because I don't know. I don't know that right now. See the logic behind that? Here's British pound. Now, pound took out its short-term low here. That's something that the euro dollar did not do, respectively. So I'm kind of like questioning, is that an SMT divergence, correlated pair SMT divergence? Now, here's for your journal. Correlated SMT divergence is when you are looking at correlated markets like British pound versus US dollar is closely correlated to euro versus dollar. Generally, they'll move in sympathy with one another. But in instances like we have here, if I was bullish, for instance, say I was bearish dollar and bullish foreign currency. If I saw this divergence between this low and this low here, making it lower in cable, or British pound versus US dollar, versus that of going back up to euro. That low here and here, we have a higher low formed in euro than that of cable. You see that? So that's a divergence. So if I was bearish on dollar, that would indicate to me that it's time to be buying euro or buying cable. In this instance, if I was bearish dollar and bullish foreign currency, which currency would I buy? Euro or cable? I would buy euro, because euro failed to make the lower low, because in sense of comparing relative lows to relative lows, euro has failed to make a lower low. So that would indicate if those conditions were there. And I'm not suggesting that they are, folks. We're just talking hypothetically here. Since cable went lower to take out that low here, that's a stop running event, and euro dollar is failing to make that lower low. So it's saying I'm not willing to go down there. And if dollar were bearish, this would indicate this is the relative strength leader. And then I would expect this currency to rally higher. Now, here's the Australian dollar versus US dollar. You tell me, is it likely to take out the sell side here or the buy side here? Now, it's real close to these, so wouldn't it feel natural to say it should spike down here and take that out? Logically, that's what I think it should and could do. But I could be wrong. I've been in markets where it's done this before and then ran away from it, because this is the logical level that everybody would look to see a breakout below. I'm not a breakout trader. I look to see price run into these levels. That's my setup. So I'm not looking for a breakout to continue in. I'm looking for a run below an old low or above an old high, and I'm targeting liquidity. Here's the dollar versus Canadian dollar. We mentioned how it took this short-term high out, bumped it, started to break lower, and who knows what it was going to do. And we had a little bit of a retracement on Wednesday and Thursday, and then Friday we had a washout. To me, it left relative equal highs. It could have easily swiped those, but it's having a little bit of a heaviness in the marketplace, and it might want to trade down into this gap here. Do I know which one it's going to do right now? No, because I can't frame it with high probability on one side or the other. So am I going to trade this personally? No. Here's the gold futures market. Okay, look at this market for real, folks. Does this look high probability to you? Is it going higher or is it going lower? Your guess is as good as mine. That's why I'm not talking about gold. Think about it. We traded from here to here. We've been consolidating. Gun to my head. Okay, gun to my head. Long-term bullishness on dollar, it might resume. That would be pressure on gold. Gold should go lower, attack the sell side over here. Is it high probability? No. Would I trade it? No. Because it can do one of two things. Stay consolidated, or run up and trade against my expectation and dollars slip lower. That's against my analysis. That's where I'm okay with being wrong, because I'm not taking a trade that would lead to that as a monetary loss.